The two most important price charts in the investment world are the 10-year Treasury, that's the 10-year US Treasury, and the S&P 500. There are no charts in the investment world that are more important than those two. One tells you what's happening with the interest rates with bonds, and many things around the world take their cue from the 10-year Treasury. And the second one, which is the one we're going to talk about in this conversation, is the S&P 500. The S&P 500 is still the most followed index in the world. It represents the US stock market, which is still the largest by a mile stock market in the world. And so many other stock markets around the world and other equities around the world take their clue from the S&P. So I want to look at what the S&P is saying today, what it's telling us, because that will tell us what is happening and what is potentially happening, and can show you what to potentially start to do with your investments. Now, before we get there, I want to go over my one thought, and this has a lot to do with what I just talked about with price charts, but there is more information in a price chart than any set of fundamental information combined. Even if you're a deep value investor and a staunch fundamental investor, which is fine, what you want to do is get your confirmation from the direction of the price chart. So if you believe that Walmart is a deep value stock and you should own Walmart, well, you probably shouldn't own it until it starts moving up, because until it starts moving up, you really can't make any money on it. So price charts are an incredible tool that can give people a very strong leg up on the competition by really following which direction the price goes. Now, before we get to the S&P 500, what it's doing, I want to point out that life is more like a labyrinth than a maze or anything else. And what you see on the screen here is a labyrinth. And a labyrinth has one entrance. You can see it right here. And what I love about a labyrinth is every time you're moving forward, you're getting closer and closer to where you want to be. And let's say you want to be in the middle where that blue dot is, and that blue dot is actually a smiley face. But notice that the cursor isn't always getting closer to the blue dot, or at least that's how it feels. Sometimes it feels like it's actually getting farther away, which it happened right now. But still, each moment you're actually getting closer and closer to what you want. Now, this is tough for the human brain because the human brain wants this type of, linear experience where every step it has the experience that's getting closer to what it wants, and it can prove it to itself. But life is actually more like a labyrinth where you don't get that linear experience where you think every step forward is a step towards your goal. And a good example of this is owning precious metals over the last 13 years, and especially over the last 12 years. It's felt very bad to many people's brains because it's actually felt like their assumptions have been wrong, their strategies have been wrong. But owning gold over the last 12 years, even over the last 2 years, is more like a labyrinth in that as long as you have a strategy that gets you, that has been proven and proven through time and history and probability, then you're going to make it to the middle because it's more like a labyrinth because you're always moving towards that. I wanted to bring that up because one of the things I see the most when people invest in the stock market is this experience that they need to be having this like automatic short-term feedback loop, like everything is always getting better a little bit at a time, almost like they're walking up a set of stairs. And that's actually not how investing works or how life works. Now, I said I want to show you one of the two most important price charts in the world, and for this conversation with you, I want to point out and talk with you about the S&P 500, which is what I have on the screen here. And if you notice, there's already two dots and a line. So let me talk about the line first. That line is its historic lifetime high. So that is about 1576-ish, within points of 1576. Now, 1576 was hit in 2000 and was hit again in 2007. And then, as you can see here, it was hit again in April of this year. And the S&P 500 has been sitting above that 1576. So that's the red line, S&P 1576 right there. This red dot right here is May 22nd, and that's the day Ben Bernanke introduced the world to the word taper. And the stock market, the S&P, immediately moved down 8 percentage points, and I'm including intraday moves. So from him introducing the word taper to about the end of June, to him introducing the idea of, well, maybe we won't taper, the market fell 8%. So the first thing that told me is absolutely this market is going up on money printing. It is not going up on value. It is not going up on earnings. It is not going up because people have a deep, deep desire to own the stock market. They don't. It's going up because this guy named Ben Bernanke, who is running this organization called the Federal Reserve, is printing $1 trillion a year. Now, he is not alone. If you combine all the central bank printing since March 6th, 2009, there's been $10 trillion printed in the world, and that money is flowing into many areas, but in this case, or in this conversation, it has been flowing into the U.S. stock market. So here at the end of June, he said, well, maybe we won't taper, and the market took off up to 1,710. And since then, it's been moving down. Now, what's interesting about this is you don't really need to worry about what's happening with the stock market until it gets back down to this 1576 area, meaning it can go sideways, but if you're concerned about the stock market falling, really you can set maybe a trigger here that until it gets down to 1576, you don't need to worry. Now what I want to do is just kind of zoom in a little bit and show you those two markers. So here's S&P, and I say 1560 because that's the very, very low point right here. The line is at 1576, but intraday on that day in June, the S&P hit 1576 and then turned around based on Bernanke's words. And this very high point right here is 1710. Now what you want to know about this is the longer the market goes sideways, if it stays above this 1576, that's strong and that's bullish because that means it's consolidating above its old lifetime highs, which is very bullish for the market. But if it falls below 1576 and can't break above it, kind of that 1576 goes from what used to be a ceiling over here in the past in 2000 and 2007. It couldn't get above 1576, but then it broke above it here in April, and now it's sat above it here in June, but it sat above it because one guy said, hey, maybe we won't continue. Maybe we will continue printing money. So really the line we need to pay attention to is this 1576 line, and that's a general line. It could be 1570, it could be the 1560, but until the market breaks below that, you don't really need to pay a lot of attention. Now, I'll add one more thing. I follow two indicators with the S&P 500 with a strategy that I call market probability. And market probability, being back tested over the last 115 years, is incredibly accurate, which doesn't mean it's always right, but it is incredibly accurate. Well, back here when the market fell here, this 8%, the short-term indicator went into a red light mode, meaning the short-term indicator said, hey, the market's not looking good over a short run. With this, and then it turned around and the short-term indicator went back into green light and the long-term indicator stayed green light. With this correction right here, which has been a much smaller correction, that has pushed the market into that short-term red light mode. Again, long-term is still green light, but short-term is red light. Why I wanted to point this out to you is because it took a much smaller correction to push it into short-term red light mode or short-term low probability mode than it did over here. And I'm not saying the market is topping, but this could be the shoulder and this could be the head of what's called a head and shoulders. And this would be its neckline right here. So really right now we have to watch, and with September coming up with the Federal Open Market Committee talking about whether there is or is not going to be tapering, the stock market is going to react very strongly to whatever is said in that September meeting, meaning if the meeting says, hey, in fact, we are going to start tapering, and the 85 billion that we're going to be printing, we're going to drop it down to 75 billion. It's very likely that we can see the stock market move down and move through this red line. But if they come out and say, you know, we just don't see enough of a reason to slow down the printing press, we're going to keep it at $85 billion a month, then what you're going to see is this line move up to the upside. But be clear about this. This market is going up because of money printing. That is the only reason it's going up, and it is not going up because of great earnings or because people have a deep desire to be in the stock market. And I want you to remember that. My final thought, or my just one more thought for the week, is find these breakpoints that need to be triggered before you need to start worrying about your investments. Some people use stop losses, which I do, or I showed you just right before on the S&P 500 how you could set some trigger points or some break points where if the market or your whatever you own doesn't break below that, you don't really even need to pay attention to it. And one of the things I've seen a lot over the years is people put way too much attention into their investments to the point where it actually makes them poorer. You guys have a great long weekend. Here in the States, it's Labor Day weekend, which officially kind of ends summer, even though summer, the season doesn't end for one more month. So enjoy your long weekend. I look forward to speaking with you next week. You guys take care.